Good morning, everyone. Welcome to the Inter-American Dialogue, and thank you for joining us to this meeting, a timely event and conversation and exchange of ideas and perspectives on a significant issue that has been discussed in different forums and different contexts regarding family remittances. Today, we're going to have a conversation on the relationship between family remittances and the implications or effects of the 3.5% tax on remittances. Um, 25 years ago, we started at the Dialogue, the Remittances program, to basically initiate a conversation on two main issues that today are much more complex, but one of them was the significantly, we used to call the term high cost of remittances. I used to argue that high is an abstract term. Expensive perhaps might be more concrete in some ways, but basically in 1998 when we started looking at these numbers, in fact we looked at them in Congress with Congressman Gutierrez from Chicago. It used to cost $50 to send $200. And $150. I mean, it was really expensive. A lot of the cost was embedded in the foreign exchange, but the commissions on sending money were significantly large. And so the average percent of sending money was over 15%, even 20% in some contexts. And the other side of the work we did was to look at the impact of remittances in economic growth in Latin America. Um, 25 years later, we basically have seen some of the results of promoting competition in the money transfer industry through technology, through firms, to increase coverage, to find a way to really offer better services to the customer. And the transaction cost today is basically 3% the value of the amount people are sending. So there is a significant, in 25 years from 15% to 3% is a significant change. Today, we find ourselves with this challenge of the cost of remittances going up by 3.5% if the tax is provided. So it's introduced. So we are here today with our colleagues talking about this subject matter. And I'm pleased to have my colleague, Dr. Andrew Seeley, who will moderate the conversation over this matter. Andrew, welcome.
Well, thank you, Manuel. It's great to be at the Inter-American Dialogue as always, and thank you for your leadership on this issue always. We have a great panel here today. We have, in addition to Manuel, who you know, we have Kathy Tomasowski, who is the Executive Director of the Money Services Business Association. Good to have you back, Kathy. And Marina Olmenpal, who is the Chair of the Legal and Regulatory Affairs Committee of FIBA, which is the Financial International Business Association. So great to have you here, Marina. And we're going to try and dive into what this legislation means, what impacts it might have, what question marks remain on this. I'm Andrew Seeley, I'm president of the Migration Policy Institute. I'm the person who knows the least on this panel about this, but you have three true experts on what's going on up here. So I get to ask them questions today. And welcome to everyone who's joining us virtually as well. It's good to have actually a nice group in the room. It's always great with a panel when you actually feel there's folks in the room, but we also feel very lucky to have many of you joining us via video, and it's wonderful to have you with us as well. So good to have both today. So let me start with Marina, actually. I mean, tell us a little bit about, this started in the House, right? It was originally a 5% tax. It got scaled back to 3.5%. Originally had a lot of exclusions. And I mean, originally the only people excluded were people who could prove U.S. citizenship, which is, by the way, I should say, not something we're generally, other than when we get employed for the first time and get an I-9, it's not the kind of thing most Americans are used to. There were a lot of question marks on that. The Senate just released their version of this, which has some notable differences on it and expands the universe of who is exempt from the tax. Walk us through sort of what's in this and what has changed between the two versions.
Sounds good. Happy to do that. And good morning, everyone. It's good to be here. And Manuel and to the dialogue, thank you for having me participate today. It's really an honor to be discussing this issue, which is a critical issue for our industry and something that we want to run through and make sure we all understand. I want to make sure to clarify that the views that I express today are my own views and not those of FIBA or the law firm that I work with or any other organization that I'm affiliated with. So any comments that I make today reflect my personal perspective and should be interpreted as official statements of FIBA or the law firm that I am with. And great question. You're absolutely right. We initially had looked at the version that passed the House in terms of the remittance taxes. The version that passed the House imposed a 3.5% excise tax on cross-border remittances after December 31st of this year, subject to certain exceptions for transfers that were made by U.S. citizens or nationals and transfers that were more than $15 in value. On Monday, the Senate Finance Committee released its version of the bill. As you well mentioned, there are some notable differences, and I'll go through those. I do want to also say that with respect to the Senate Finance Committee's bill, it's actually quite complex, and we are still reviewing and evaluating. So don't take anything that I say as an official statement and finalize, because there's a lot of complexity to it. And quite frankly, the more you read it, the more you question, where there might be some components that may need just a little bit more clarity.
And we should definitely highlight that, right? I mean, as everyone here knows, the American legislative process is not linear, right? I mean, lots of changes happen. So lots of things could change in the Senate, and they could certainly change in reconciling with the House.
Exactly. Exactly. So it's a moving bill. It's an active bill for sure. So the Senate version. So the Senate version still imposes a 3.5% excise tax on certain remittance transfers that the senders must pay. So that stays consistent. It also requires that the tax be collected by the remittance transfer provider and that tax be remitted on a quarterly basis to Treasury. It also imposes secondary liability on any remittance transfer provider for any tax that is not paid at the time the transfer is made. And here's where some changes or some differences exist. So the remittance transfer tax provisions of the Senate bill require the remittance transfer provider to collect the tax from the sender and remit it on a quarterly basis to the IRS. That's consistent, but here's the change. For senders that are individuals with work-eligible Social Security numbers who are eligible for a tax credit, for them to provide, and for the remittance transfer provider to collect from them a certification that they intend to claim a credit for the remittance tax that they pay, and to collect from them a full name, full legal name, an address, and a Social Security number. So the House version that we had reviewed, again, provided limited relief to U.S. citizens and nationals. And so what we're seeing now with the Senate bill is that this is much broader in terms of it's been expanded in terms of who can benefit from a credit for the remittance tax that is paid. And again, the broader expansion is to anyone who has a work eligible Social Security number. It also provides, so the Senate bill provides that the sender would be able to get a tax credit for the amount of the remittance if they can demonstrate to Treasury that they paid the tax and that they provided the remittance transfer provider the required certification. With the collected tax, the remittance transfer provider would report to Treasury two sets of information. For those senders who certified their intent to claim a tax credit, the remittance transfer provider would provide to Treasury their name, address, and social security number. They would provide the amount of the tax paid by the sender and the amount of the tax remitted to the remittance transfer provider. For remittances in which a credit will not be sought, the remittance transfer provider must report to Treasury the amount of tax paid for the remittance transfers and the amount of tax that was remitted.
Pays the tax, and then you file for the credit
Correct.
on the other side. Okay.
But that's our interpretation.
That's the interpretation.
Exactly, at the time of the transfer. That's right. Significantly, and you had mentioned earlier, the Senate bill creates certain exceptions for particularly remittance transfers where funds being transferred are withdrawn from an account held in certain financial institutions. These are primarily insured banks, commercial banks, trust companies, agencies or branches of foreign banks in the United States, credit unions, broker-dealers registered with the SEC, and broker-dealers in securities commodities. The other exception is for remittance transfers where the funds are being transferred or where the transfer is being funded by a debit card or a credit card that is issued in the United States. So that's a significant exception. We're now looking at remittances that are initiated from, for example, right, an individual bank account, right? That's a cross-border transfer not being subject to the tax. With respect to accounts maintained with broker-dealers registered with the SEC, same thing. So I think with respect to one of the concerns that some of the industry groups had raised, including FIBA, which was foreign investment, and the House version really raising concerns in terms of the appetite that foreign investors would have for investments in the U.S. This provides some comfort for sure. So that's been very helpful. The Senate bill also adds what they call a rule of construction, which provides that the remittance tax applies to any remittance transfer for which the sender provides cash, a money order, a cashier's check, or any similar instrument as determined by Treasury to the remittance transfer provider. So our reading of that, or my reading of that, is that the bill attempts to focus on the cash remittances, cross-border remittances that are initiated in cash, family remittances. So that's, I think, where we're sort of going with this. The bill still cross-references the Electronic Funds Transfer Act and Regulation E with respect to the definition of the terms, remittance transfer provider, and sender. So that's consistent with the House version.
Remittances specifically in this?
So that's a good question and something, we're looking at. But I think you're looking at, again, anything that is, as mentioned in the bill, funded with a debit card or a credit card, right? To be excluded.
So I would just add in, I
Okay.
think Marina's point about, that we're still analyzing this. There are some open questions with regard to digital. For example, in the area that she just referenced with other types, there is some conversation being had that this could cover stablecoin, right? And those types of transactions, perhaps they could be excluded in a regulation that's written by Treasury. But, at this juncture, it's uncertain. The second area is that she alluded to the fact that, includes information and definitions from the Electronic Funds Transfer Act. And in that act, they specifically note that the debit card or credit card must be on a payments network. So it raises the question, does the transaction have to be on the current payment rules? We've seen in the news lately, for example, Circle has introduced a product and potential for their own payment rails. Would that exclude transactions there? I'm not sure that all of these scenarios have been given the appropriate detail and thought to them at this point, because there is a speed at which they are trying to, complete this legislation. So, no specific answers, but I think there's a lot of questions that people have to look at from their own individual perspectives.
I think that's very helpful, Kathy. Thank you. And I think, one of the things that, again, we're still evaluating the bill, but it does raise a number of questions where I think some clarity may be helpful. Digital is one of them. I know we had discussed also P2P transfers through digital wallets and whether those appear to be excluded. It would seem so, but getting clarity on that as well, would be something that's helpful among other questions.
Just to add, I mean, it's today, especially the remittance payment ecosystem, but the distinction between a remittance payment ecosystem and a cross-border payment ecosystem is too thin. It's subject to interpretation by the purpose. But the payment ecosystem basically today gravitates or triangulates along cash transfers, banking financial institution originated transactions, and the gray area, which is currency transactions that are outside of the regulatory context of bank or the regulatory context of the Electronic Funds Transfers Act. And that's where it becomes this piece of legislation introduces a gray area or opens up for a gray area where you don't know if digital currency, because digital transfers can be bank-originated transactions, but digital currencies like crypto or stablecoin may be in this gray area because some of these transactions are originated through a bank account, but others are originated through the ecosystem of the cryptocurrency market. So, blockchain technology supporting Bitcoin or, Strike, etc. So this is where it becomes kind of tricky. And it raises, a number of additional questions regarding the other subject that we'll be talking about here.
Why don't we move into the impacts of this? And I think there's, we've all been thinking a little bit about this, and Kathy, maybe we can start with you, which is, what issues is this going to raise in terms of institutions that are involved in transferring funds, whether it's, banks or other remittance providers? What are the issues on the table here from the institutional side?
So the Senate bill, I think, has many improvements from an operational perspective in that the verification of citizenship has been eliminated from that. And that was going to be a significant challenge for your companies, whether you be a digital company or a cash online. The companies still will have to collect information that they're not accustomed to collecting, So for an American citizen, a green card holder that has that Social Security information, you are going to now have to complete a form and hand over that information to your cashier in order to effect a transfer. The company, the business company, that small business is going to have to set up a procedure, right, to collect the information, to store that information. There are concerns of privacy, being affected. I think Cato did a piece that they were concerned about the amount of information that the government is now collecting from individuals there. So that's important. There's also added compliance for these companies, right? So there's a new checks and balances and reporting system. And we have made significant strides, I think, in the industry in the last 20 years. If you look at the programs that they've put in place for money laundering, AML programs, the licensing strength, very regulated entities. They're going to have to add to that. And I think that that will present a lot of challenge. I did want to just give you some numbers, and these aren't even all of them, but if you look at, for example, just your small business communities, like from the small grocery stores, there are 22,000 of those nationally. You look at Western Union agents, there's about 68,000. Those are, you know, almost 100,000 just small businesses from one perspective, right? Not even all of them being taken into account. And it may be that that small company that only might do 500 transactions a month may decide to get out of the business. You know, it's not worth the extra compliance, the changes to procedures. You know, you have to train people. So there's a lot associated with that there. And, you know, I'm not certain that it's going to provide any benefit to anyone in the long run because of it.
Any concerns around liability? I mean, I don't know, you suddenly get an investigation. Just occurred to me as you were talking. I mean, you know, turns out that 10 of the customers were using social security numbers that then pop up in an ICE investigation as being, you know, or an IRS investigation as being fraudulent social security numbers.
It's not addressed in the.
Yeah, I mean, and clearly, right. I mean, that's if I were a small business involved in remittance sending, that would certainly be one of the things. You know, maybe not for the remittance provider or bank, but certainly from, you know, the storefront that's processing and taking the information. I would certainly want to know if there's a liability issue.
So I'm going to just say that it gets back to your point from the banks and, you know, what information are the banks going to require from their companies, even though it's not, you know, a bank doesn't have to know your customer, it just has to know its customers, but you know, is there going to be a greater scrutiny of your customers and your procedures, and therefore the bank may or may not choose to continue the relationship because it's just a lot of work now.
Yeah, I was just gonna, sorry, I was just gonna mention that when you are collecting personal identifiable information, including social security numbers, just as Kathy well mentioned, you know, this information is protected under federal and under state law, and there are requirements that, you know, need to be satisfied in connection with those. And whenever you're collecting that information, there's risk, right? The more you collect, the more risk you're subject to. And so I think that's a reality and something that, you know, the industry needs to think through and, you know, how to implement controls and what those controls will look like. That's something to be discussed. I think to Kathy's, you know, excellent point, on the bank side, the question is, well, you know, we're aware that, so the banking industry is aware that there's additional requirements as it pertains to remittance transfers, right? And so the MSB clients that I have and I maintain accounts for, what sort of diligence am I going to be as a bank expected to conduct, and what sort of oversight am I going to have to do over the industry to make sure that, if I have to, right, make sure that they're compliant or not. And so that's something to be considered because the cost of banking could also go up. So it's not just presumably the cost of the remittance transfer, but the operational cost on the MSB that, you know, takes on that information and takes on the secondary liability for the remittance tax, but also the cost of getting access to banking, right? It might, get more expensive for the bank to provide those services. And so,
For certain kinds of individuals. Right.
exactly, exactly. And so, when the bank is doing that diligence and assessing the relationship, that's something additional to be considered, with respect to MSB customers. And as we all know, MSBs already have some challenges in getting bank accounts. And so that's going to be something that, we do need to think through and, how we're going to deal with those issues.
Manuel, maybe we can go to some of the impacts. I mean, you have spent on a lot of time working on the formalization over 2 decades, now more than 2 decades, on the formalization of remittances, on trying to get people into, to actually send things. I mean, there was a time where much of the money flowed, especially to Mexico, flowed back in cash and in informal transfers. We've seen this. There still are. There's some percentage that does that to different countries, but increasingly we have seen a formalization. How does this bill, at least on the Senate version, how does it affect the formalization of remittances, and what risks are there?
Well, the tax becomes a disincentive to stay in the system. What we looked at when we analyze the global money transfer markets, there is a strong relationship between stiff regulations that include higher transaction costs and the use of informal sending mechanisms. So in places, and this happened especially in the African continent, is not as much because there was a lot of self-correcting process in there. But when there was the regulatory system basically created very stiff money transfer controls on the origination and in the destination, Africans in Europe sending money to Ghana, for example, people will use informal channels. And statistically, for 1% increase in the transaction cost, the use of informal fund transfers will increase by 6%. But also, there is a cost element to it too. And immigrants, don't have an infinite amount of resources. They have a very limited income capacity that in the US, it averages to about $3,300 a month. So sending $400 is a lot of money. But on top of that, if your transaction cost goes from 3 to 6% or 6.5%, you're actually spending 1% of your monthly income just to pay those costs. And what typically people do is send less money. So you will see one side going informal and another side who may use pay the tax but send less money. At the end of the day, I mean, we did a survey in 2017 when this subject came up again at that time, and we found that 60% of people say that if the tax was put on remittances, they will go in different ways. And about 40% of people say they will go informal. Now, today it's very hard to know what informal means, unlicensed, but definitely it's a challenge. And, in addition to the challenges that Kathy was talking about, I mean, the financial risk of going informal today is much higher than it was before. But the challenge of exposing yourself now through the money transfer vehicle, your personal identification and your social security number opens an opportunity for illicit identity fraud. And this is an issue that definitely, is a shot in the foot when you're trying to prevent actually this type of frauds, of identity theft, which are basically on the rise. So, why you have to open this another vulnerability in the US national security context. So you do have a number of vulnerabilities. The informality of the system will get you into informal fund transfers that are unlicensed, and that poses a challenge. Sending less money will have an effect on the recipient households. We did a conservative estimate of the impact of these flows, and it will have an effect of reducing transfers at least 5% on the next year.
I can't help but think that the people who know how to transfer money and get around regulations and do informal channels well are drug traffickers. They spend a lot of time doing this. Any risk on this that they will see this as an opportunity and move into some of these spaces? And obviously, people won't know who they're dealing with. But I mean, the first thing I thought of when I saw this, when I saw originally the 5% tax, is this is sort of a boon for organized crime that actually knows how to move money outside of sight. I would see a big, if I were on that side, I am not, let me clarify. No inside knowledge whatsoever. But if I were someone in organized crime group, I would be sitting there thinking, okay, I actually know how to do this. And, I think we can make a little bit extra money on the side here.
It is, look, money laundering has one disadvantage for the average remittance sender, in the sense that the drug traffickers that use money laundering mechanisms usually launder amounts that are over $20,000. So this is P2FAO. This is just, really tiny amounts of money that will pose a burden. But the rails, the vehicles that organized crime networks use sometimes are underground, that could be utilized or could be offered to certain populations or certain groups to take the opportunity and offer you this mechanism. Now, once you are in that, the situation becomes more complex and more dangerous, because then if organized crime networks offer services for small fund transactions, then we're exposing the U.S. economy to a larger criminal activity in a context where we have actually been able to increase controls of illicit financial transactions.
I just
Kathy.
would like to just jump in on that too, is that, our industry has been great partners with law enforcement, and we are sort of eyes on the ground for them. We monitor transactions, we look at changes in patterns, we issue suspicious activity reports. We are fundamental to security in the nation and preventing laundering and other nefarious activities. So pushing us into unlicensed or unregulated, our customers into unlicensed or unregulated avenues has a really disastrous effect. And Manuel mentioned it, but I don't think people realize how much regulation and how those companies are sort of eyes on the ground for law enforcement.
Definitely. Let me ask you one last question. I'm going to come back to Marina and Kathy and see if there's anything else. Then we're going to the audience, by the way, those in the room as well as those that are with us online. What about the effect on development? I mean, one of the things that we now know from multiple studies out there is that remittances are certainly not a cure-all, right? There's no example of any country ever developing solely through remittances, right? That doesn't happen absent other policy choices. But it is a powerful tool for households to change their life circumstance, and sometimes entire communities to change their life and to actually detain migration over time. That there is within a generation or two, households that have ongoing remittances often show patterns of upward mobility that otherwise might not have happened. And actually migration, irregular migration particularly, slows in those countries. What fears do you have around that?
Well, I mean, in general, we've been working on financial inclusion in many countries in the developing world, not only in Latin America. What we have learned is that remittances increase disposable income and in turn increase savings. And that increase in savings actually had a negative correlation with the intention to migrate. And we actually, in Guatemala, where we have been working consecutively for 10 years with hundreds of thousands of people, we see that year on year, the intention to migrate decreases as we get people to formalize their savings. So that it's danger. But the other way to think about this is to look at the chart I printed out for you. And the first graphic basically shows those populations that are more likely to be affected by the tax. Now, if you look at the countries, they happen to be the nationalities that come from the most politically difficult countries, the countries that are economically weaker. And it does raises a number of questions, one of which is that, for example, a country like Honduras, which is number one, or Nicaragua, in these two countries, 30% of private consumption, it's income, remittance income. I mean, 30% of private consumption is 90% of GDP. So a decline in remittances will have a direct effect on private consumption in these countries. And I'm not talking about only, we have Honduras, Nicaragua, Guatemala, Venezuela, El Salvador, basically the CHNV countries, Cuba, Haiti, Nicaragua, Venezuela, plus the other Central American countries. So you are faced with quite a few challenges. On the one hand, the temporary protected status and the humanitarian parole is being discontinued for people from, these four nationalities. On the other hand, you have the tax increase for those nationalities who happen to be less likely to have a social security number because they arrived recently. They escape their home country for political reasons predominantly, or due to state fragility or state failure, as in the case of Haiti. And so, you're dealing with a time bomb because, and I'm thinking specifically of Haiti. The impact of this tax on Haiti will be devastating because there are 500,000 Haitians who will lose their status or already lost their status to stay in the United States as of last week. So, and Haiti dependence on remittances is significant in a moment where, you have not only the state has already collapsed, and income basically depends on remittance flows. So the implications of this are far more complex than just an effect on income on the sending side.
And so we're talking about countries, I mean, certainly Haiti, Honduras, Nicaragua, I mean, both large, Venezuela, El Salvador, although slightly less because it's a more established population, more people, I mean, as dependent on remittances as a percentage of GDP, but a population more likely to have social security numbers, but still important.
Exactly.
In Mexico, it's regional, obviously. And
Mexico is
India
a
regional.
matters of numbers.
Yeah.
Yeah, because you have a large significant population in irregular status, and some of them don't have social security numbers, whether because they are irregular or because they didn't get one.
So Mexico, Colombia, Ecuador, other countries, it would have a huge regional impact, but perhaps a little bit less on the national on national income. Let me come back, Marina. I mean, anything that before we go to the group here, anything that you want to add?
To Manuel's point, I thought that was a great point. I think it also stresses the fact that, the proposed remittance tax creates an incentive for those persons that don't have a social security number to really use informal channels. And again, to the point that was just made during the panel, the challenge with that is that, we do have AML requirements, right? MSBs do have to comply with monitoring, with reporting requirements for suspicious activity. Sorry, anti-money laundering, apology, anti-money laundering, program requirements, monitoring, reporting suspicious activity, really working with law enforcement to identify and report, these types of illicit activities. And so when you're looking at imposing that tax, again, I think one of the questions is, are we creating an incentive for, again, persons that don't have social security numbers to go ahead and use the informal channels? And then how much in terms of remittances, how much are we going to see go through those informal channels? And is that something, that we want to do? I think that's just something to be considered.
And Kathy, and I mean, going back to where we started, I mean, if this is going to go through, the Senate bill certainly is much better structured bill, right? I mean, just technically structured, right? It seems to address more issues, but with some question marks there.
So one of the points I guess I would also make is that this past year in the states, we've seen significant activity. So we saw 18 states propose 29 different bills on taxing remittances and also different types of identification bills, various reasons in taxes. In all of those instances, with the exception of one that's still in a legislative session, we have been able to push back and demonstrate how many unintended consequences there are of this bill, and the states have not moved those bills forward. I think that that's an important aspect. Although this bill has improved, I think that, you know, being able to continue to message and demonstrate all of the unintended consequences that will come from this bill is critical so that we can potentially have it removed. The original House bill that Marina talked about projected $22 billion in revenue coming from the tax over a 10-year period. Simplifying the math with some of the exceptions, and there's, you know, people could argue different things, but at the very least, without even informal channels, you're going to see a reduction to at least 11 billion over 10 years because you're taking out the digital and the card funded type transactions. And then you can get into all kinds of discussions about, you know, the informal channels and other things, further reducing that. So there will be a lot of expense by businesses, a lot of increased compliance, a lot of loss of information to law enforcement, a lot of American citizens having to give up their privacy for a very minimal return. So I think that's important to consider and to convey that to appropriate individuals.
Thank you. We're going to go to the audience here, and you have your hand up. So you are the first mover in the room. Yeah.
Yeah.
Start with questions in the room, and then we will we'll go to folks online. And let me give you a microphone so that they can hear online.
Thank you. My name is Sonia Schott with Schott International Consulting. Very interesting. I was wondering if you can comment on what will be the primary goals to implement this bill, since it is to crack down immigration, the illegal immigration, since I think he mentioned that it's not really going to happen because maybe it will be an incentive for people to come here instead of staying in their countries. It is to collect more money for the US. He also mentioned the amount of money sent by remittance is not really huge. So, or it is in a way to prepare the financial system, since many countries are considering to include digital currency. And right now, people are using this cryptocurrency actually to skip the system. They don't need to pay anything, any fees, or to tell anyone what are they doing with their money. And that is because El Salvador already adopted the cryptocurrency. So I don't know what kind of impact this will have on that. Thank you.
You want to go, Kathy? He wants to.
So I'll just say, I think that the rationale behind the tax bill varies, right? I think there are some groups that feel that it will increase revenue, and this particular bill in Senate is trying to find revenue to cover some of the expenses associated with the other aspects of the bill, like there's Medicaid discussions and SALT and all these other things. So they look at it as a revenue. I do think that it is also, reflective of trying to discourage people from using remittances and therefore affecting the immigration issue. I think, spokespeople like Manuel helping to demonstrating to people that there is sort of an inverse effect there is important, right? I don't think everyone understands the value of family remittances and the effects on immigration. And, I think it's important for all of us to be very fact-led in those kind of communications, and it will help.
Just briefly, I mean, there is definitely a political motivation. It's a motivation that is not new, but it's the first time that it has reached this level of political capital or appetite for approving it. The motivations are mixed. I mean, Kathy is right. I mean, some people, the text itself doesn't explain the motivation of why putting the tax. Some people who have been very staunchly supporters of it argue that the purpose is obviously intended to demotivate people to migrate. Now, this is the subject of a different debate, but the bottom line is that migration has occurred even in the context of the past 5 years, where you see the surge of migration, is that it has statistically correlated to unemployment. There is definitely a demand for foreign labor that year on year correlates directly with migration. So if you, at this point in time, what we are seeing is a significant declining migration, which was already taking place since 2023. And it was a process that was resulting not only because of immigration policies in the US or restrictive migration policies, but also because of demographic trends in the developing world, especially in Latin America, with the fact that so many people have migrated, that the demographic composition of the labor force has been declining. So the number of people willing to migrate couldn't migrate because they had a burden to themselves. With this shortage of income resulting from taxes, you will have economic pressures in the developing countries. And that economic pressure may lead to what with your feet, because still, we are dealing with serious foreign policy problems in many countries. And so this is a more complex issue. So again, the motivations may be political, but everything is about the fine print, the content of what you try to come up with and the adverse effect that it can have, the backfiring effect.
Thank you. Anyone else here want to jump in? Diego Chavez, we'll go back here. And then we don't have an extra microphone, do we? That we can use? Yeah, we can share one, Manuel. Okay.
Thank you. Manuel, thank you so much.
Who are you?
Oh, Diego Chavez Gonzalez. Diego Chavez Gonzalez. I'm the senior manager for Latin America and the Caribbean at the Migration Policy Institute. Manuel, I had 5 questions, and actually you already answered 4 of them. So this panel has already.
That's fortunate. Okay, good.
To be super valuable. But I do have an additional question, which is about, like, I'd be curious to hear your take on both the short and long-term effects about for the countries in Latin America. What kind of macroeconomic or social disruptions do you foresee? And how should governments in the region be preparing, whether through financial policy, migration engagement strategies, social protection system, to mitigate the potential fallout?
That's great. And if you don't mind passing the microphone back to this gentleman in the back. Oh, yes, you're
Hi,
on.
Raúl Saavedra. I'm from the Mexican Embassy here in
Oye,
Washington.
Raúl, gusto verte.
Igualmente. So my question is more from the focus of some of the migrant communities. So from the temporary workers, how do you think it would affect them in terms of, I don't know if they're issued a social security number, are they capable of doing a rebate? Because that would be the case. Or given that they have a social security number, do they usually have a bank account? Or would that be the best way for them to kind of not get taxed, given that if they have a social security number? I want to see what options are there for temporary workers.
That's a great question. I'm going to throw in some of the questions that are coming from the online audience as well, but there's one that dovetails with that, which is who's getting caught in the middle of this that are sort of unintended, because there's a set of people who have temporary status but are legally present. You know, the H2 workers are the obvious one, which certainly affects Mexico overwhelmingly on H2A, and still large majority on H2B, but also people on J visas and F visas, and depending, I don't know the ins and outs of who gets Social Security, L visas, which are intercompany transfers. Some of them are eligible for Social Security numbers, some of them are not. Also there's a question, I mean, I think you raised timing, right? You're an agricultural worker, you're up for 6 months and then you're headed back. Can you file for a rebate in real time, that reaches you before you leave? I mean, that's I think an interesting question for sort of a broader population of people who are legally present in the US, but may find themselves caught up in this in unusual ways and have to navigate it. So I don't know if anyone's thought about that. As well as, you can answer, Diego, on how Latin American governments should be responsible. I have not noticed Latin American governments as engaged on this other than the Mexican government as I expected, but there may be a lot going on in the background.
Yeah, I have reached out to several governments and only one has been more receptive. The other ones do the numbers and they say, oh, it's only $800 million, but we're getting 20 billion. So we can deal with that. But the understanding of the macroeconomic impact, it's one that is lacking. And it varies from country to country. Let's take, for example, Guatemala. When I looked at 15 years of data from 2006 to 2024, quarter macroeconomic data on GDP, consumption, investment, you include the remittance variable split into investment and consumption. And what you find is that a 1% increase in remittances increases GDP by 15% in that country. Now, invariably, in Guatemala, remittances have increased at an average of 13% for the past 15 years. So that means that a 10% increase in remittances to Guatemala increases GDP by 1%. That's basically close to half of Guatemala's GDP growth over the past 10 years. So if remittances were to fall 10%, you will have an economic recession in Guatemala because a 1% decrease will decelerate the Guatemalan economy substantially for more than 4 months. So that's Guatemala, which is your best, a good case. If you look at Honduras and Nicaragua, where a 1% increase in remittances increased GDP by 33%, by 0.33%. So a 3% increase in remittances increased GDP by 1%. In that case, the decline will be much more severe. It will have a big blow in this country's economies. And to the authorized temporary work visas, it's a very good question. I don't think it's captured in the text because some workers, I mean, it's about 500,000 people who actually come to the US on the different legal authorization visas, including H2A, H2B, J1B, and the NAFTA visa, which still exists, and a few other ones. It's 500,000 people. Only H2A is 300,000 and 70,000 for H2B.
And it's probably more than that now, actually, because J's and F's, and
Exactly.
Yeah. I mean, which are technically not work visas, and yet, I mean, J visas allow you to work. So
allows you to work, and so
I do think allow a Social Security number, but I'm not sure. Don't quote me on that.
I think the temporary worker doesn't get a Social Security, but they get the ITIN, and they do have an identification mechanism to send money. I don't think they are covered under the text of this law because unless they can open a bank account, they wouldn't be exempt from sending money from the tax. You can open a bank account, a non-interest-bearing
well.
bank account, and some do. I mean, the percentage of people on irregular status who open bank accounts is significant. So it's, it's an important tax contribution that they make that it goes unnoticed. But I think it's a gray area, especially for H2A and H2B.
So Manuel, I would just also add in there that you actually have to file a tax return and get the tax refund. It's not,
Much more complicated.
it's a
yeah.
more complicated
Right.
process.
Which
So
not
even if,
necessarily H2 workers are going to be doing.
depending on your timing,
Yeah.
you have to, just like all of us, they release at the end of January the details about the tax year, and that's when you begin to file your taxes. So
I mean, which is always so easy to navigate already. Yes, but not a tax attorney. But I also think, I mean, but it does tell you, I mean, this really was going to shift a lot of things that were not the unintended populations that are here legally. So H2s, Ls are different because Ls tend to be here a long time. Intercompany transfers, H1Bs tend to be here a long time. But J visas, people who come up on J visas for temporary programs is increasingly work study programs. There's a number there's a number of the F students who work on the F visa. They're here long term, probably fine. F visa holders, I believe, if they have work authorization, get a social security number. But for people who are on temporary or exchange programs and others, it may be more of an issue. So if you have to be here to actually file taxes, it means understanding how to do that and ability to do that perhaps once you've returned to your country. Yeah. Let me ask a couple questions that popped up here also. This is from our online audience. One is, how do you distinguish, again, on the sort of the gray areas, how do you distinguish remittances from other kinds of transfers? For example, someone asked about people from other countries who invest in the United States and then want to send their, the money they've made back. I assume that's mostly taken care of by banking, right? I mean, those are mostly people who would have bank accounts. So that's probably, but worth thinking about that one. How much do people who are sending, the presumption is that this is a tax on people who don't pay taxes. I think, some of the rhetoric we've heard on this in the past, again, on the motivation, some of the motivation is discouraging unauthorized migration. Some of the motivation is raising, fiscal revenues. But some of it is also, hey, these are people that are not paying taxes, so we're going to tax them indirectly through this. How much are these people not paying taxes to begin with? That's sort of the going assumption. Let's stop there, actually. Well, and do you think this is going to pass? That's a question for the audience.
But again,
They have to be able to apply it. They have to be able to file a tax return then. And get a rebate, right? Exactly. So that does, for people that are temporary that may not be hugely literate in the U.S. tax system, right? Nor, I mean, you people who are here permanently are likely to be able to navigate this. People that are here temporarily, probably this is going to be a learning curve in the best case circumstance. Yeah.
add one other group of individuals that, we think they have a lot of bank accounts that aren't really accounted for and why they use services there, the military. So people forget about our military using our services and families sending money over to support them. And yes, they may have bank accounts and change that, but
Speaking of active military stationed abroad,
yes.
getting money from family members.
Yes.
Yeah.
Also those associated with religious communities who are doing outreach and missionary work. A lot of times that money is sort of collected in a group and cash is, goes down and it's sent. And a lot of times the places that you are sending or the agents maybe that you're sending your money to have to do with how the recipient will get the money and where they'll get the money, right? So not every recipient will have a bank account, and maybe somebody that's sending their money has more access to a broader network through an agent that they're speaking with versus a digital player. You know, the digital players are getting tremendous, they cover a tremendous network, and I'm not sort of saying that they don't, but there are still those exceptions there that, again, I think is another unintended consequence in a population that's not really being considered in the scheme of things.
These are gray areas where there are conceivable workarounds, but they certainly will be caught up in the changes, right? I mean, you can think of a church community that raises money for another church in rural Bolivia or Eastern Congo or somewhere else where there aren't banking services, right? And so you could conceivably switch into raising cash in the church, usually go down to the remittance center, send to another. But I mean, you could figure out how to either bank it if it's possible or use a digital, but it is going to create unintended consequences.
No, I was just going to add, I think these are all great points. I think one of the things that is reflected by these questions is the fact that this is a bill that we're all still analyzing, reviewing, and questioning what the implications are. With respect to your church example, I think one of the things to focus on is the Electronic Funds Transfer Act and Regulation E, and the fact that the terms are really defined there. So you're really looking at consumer remittances, so initiated by individuals primarily for personal, family, household purposes. So again, on a sort of transaction by transaction basis, I think with respect to the social security number question, which I think is a great question, I am not an immigration lawyer and I am not a tax lawyer either. So I will say that. I think it's a question that needs to be analyzed to see what the implications are. One of the items that I noted in the review of the bill is that it imposes on the remittance transfer provider the requirement to, you know, for the sender that will certify that they're going to claim that credit in their tax return. The remittance transfer provider has to request from the sender information that seems fairly easy, name and address, fine. But then it says social security number as defined in section 24H7 for purposes of complying with the requirements of, you know, the remittance tax. Are we talking about agents having to be able to understand what kind of social security number they're being provided? Are we analyzing? I mean, what kind of specialty are we looking for agents and MSBs to have with respect to identifying this information? I personally don't have it. I have no idea. It may be an easy answer, by the way, but it's definitely
Certainly
something
a
that
learning curve.
needs to be looked into.
There was a question from the audience also about privacy concerns. I mean, it's something probably anyone who works in any business or nonprofit we worry about occasionally in our own limited ways. But again, the store that is a remittance, you know, that takes remittances, that's recording the social security number, the 7-Eleven that gets a break-in and their paperwork is stolen, right? Someone goes in the cash register, grabs the files they see. How much do we worry about that? I mean, so we're having social security numbers now we have social security numbers in lots of digital places, by the way. You know, I mean, most of us probably have our social security number somewhere in the deep web, by the way. But, you know, we hope it doesn't come back to bite us at some point because there's been a lot of identity theft on the web. But the idea of having physical social security numbers stored in thousands of locations across the United States, which are not used to storing privately, you know, personally identifiable information.
Back to the point that we made earlier, the more information you collect and the more protected personal information you collect, the higher the risk that you take on and that you're assuming as a business, because you could have situations where there's fraud, right? There's, you know, stealing of that information, et cetera. It's just a matter of risk. And so it's something to be considered, what the implications are, what controls would need to be implemented, and the cost of those controls as well. I think it's risky. One other thing that I was just going to answer that I know the question came up in terms of foreign investments. I think the Senate version of the bill really mitigates that concern by having created the exemption or the exception for banks, for broker dealers, and transactions, funds transfers that are initiated through bank accounts. So from, at least from my perspective, I don't think that's a big red flag right now as it was a serious concern before. I think right now, again, what we're looking at is those cash remittances, family remittances that are going cross-border.
By the way, do undocumented immigrants pay taxes?
According to several studies, at least half of unauthorized workers do have use the ITIN to report their income tax. And I mean, anecdotally interviewing migrants, one thing I learned is that on January 2nd, the first thing that most irregular migrants on irregular status do is file their income tax. I mean, it's a fascinating cultural thing, but
It's absolutely fascinating. And I mean, parenthetically, this behavior could change with the increasing interconnection of government databases, right? We're seeing the access to Social Security. I think some of us have raised that as a concern, that the more people who have been comfortable giving their information and paying taxes, even though they're in unauthorized status, think that their information may be shared for enforcement purposes, we may see that decline. But we've actually seen a large increase in the number of people in unauthorized status who actually do pay taxes. I mean, it's actually quite, yes. And if there's any questions in the room, we're going to the last round of questions, and then I'm going to come back and ask you the question again that you're all avoiding about whether this is going to pass. So,
hello, my name is Diego Delier Snyder. I'm with the Aspen Institute Latinos and Society. Thank you so much for your panel discussion, super insightful. My question in particular is about to what extent you foresee remittance taxation becoming an additional tool in the international relations approach of this administration in terms of, in a similar pattern or way as tariffs have become, right? Like to what extent remittance taxation can be used as a way to punish specific countries that might be more vulnerable to this tax because of the percentage of nationals from that origin being present in the US. I have one anecdote in particular, which is I recently saw Senator Schmidt from Missouri kind of proposing to raise the bill to 15% and referencing a speech by President Sheinbaum of Mexico that he connected to the riots in Los Angeles, the protests in Los Angeles. So I was curious to what extent you foresee this becoming more of the rule, like policymakers focusing on the international implications of a tax on remittances in specific countries. Thank you.
fascinating question, Diego. Good to see you again. Yeah, that's intriguing and disturbing. Anyone else that want to dive in before we go? Yes. Since we didn't get her the microphone, sorry, what's your name? Diana De Castro is asking whether if we're seeing if it's a red state or red versus blue state thing in terms of the remittance tax at a state level, or is it sort of cross party lines? I'll go back to you guys on all of this.
The states that we did see this year were states that we call trifecta states, where the governor, House, and Senate all reflected the same party.
Does anyone want to answer on the other question? Is this another tool in international diplomacy, if we want to put that way, toolbox?
I can quickly say, I can tell you two things. Number one, the only precedent that exists is Cuba. Number two is that if we look at the political process so far, the legislative process of the past 2 months regarding this particular initiative, what you see is the opposite, is that the more you read the text and the debate over legislating cross-border money transfers, the more you realize that it's more of a problem than a solution to the subject. Remember that migration, even though it's becoming, it officially almost became an intermestic matter, a foreign policy issue, which it wasn't 10 years ago. Migration is a homeland security matter. It's always been in any society, in any country, but now is a foreign policy problem too. Now, you can exercise other pressures that apply, for example, when it comes to free trade. There are chapters under free trade on financial access to markets, access to financial markets. And you could use that instrument to exercise political pressure. One case in point that is an easy pick and it hasn't happened is Nicaragua. Nicaragua has certain sanctions, has a legislative regulatory environment that protects people who have been sanctioned. And that in itself is a financial risk to the United States, to any banking financial institution that has corresponding banking relationship with Nicaragua. So legally and politically, the United States can actually resort to de-risk Nicaragua, financially de-risk Nicaragua. It hasn't happened. I think the issue, it's basically, again, if the more you read about these issues, the more you realize that financial pressure is a powerful tool, far more destructive than you can imagine. So you want to be very careful on how to work with that.
Final question, and we're going to move towards the close of the session here. What are the chances of success of this initiative? I know that's always dangerous to and maybe no one wants to take a gamble on this, but is this sort of a moving train that's likely to keep going? Is someone hitting the brakes on it? Are we more likely to see the Senate version than the House version? The Senate version looks, on my quick read of it, just a little more polished I mean, it's also less broad, obviously, but it also looks like they tried to really reason in some of the concerns that had come out of the House version. So if we see a version, is it more likely to be the Senate version, or it's going to be a mix of the two? I realize predicting anything in the U.S. political process, especially in the U.S. Congress, is risky, to say it nicely. It is a challenge. So you will not be held to whatever you say here, but what do you see happening next? Should we go in? You want to go first? Smiley, Kathy?
So I would say that the MSBA is still going to work very hard to put forth a lot of energy to demonstrate the unintended consequences. So we are still hopeful that this provision will be removed from the bill. The bill in the Senate does provide significant relief from the House bill, but it is still with significant consequences. And I do believe, this is a personal, not MSBA, that the current legislation is significant. It's a 1,000-page bill. The remittance tax is 3 pages in the scheme of things. So the Senate has a tremendous amount of information and higher priority, I'll say, issues in which to deal with. So I think it's important for all of us who may be concerned and who understand the effects to be speaking up, to help educate them. And it's through that education process that we will be able to get people and sponsors to say, it is not worth us adding this provision to this bill. It's not giving us the revenue, it's not affecting the immigration, and it's hurting law enforcement, and it's hurting American citizens. And that's, I think, the important message that we have to get.
Marina, what do you think?
I think those are great points. From my perspective, I think an answer to that question is it's just too early. For me, it's just too early to tell. There are different versions. I think this, however, the time that we have right now is really giving us an opportunity to look at the bills, understand the bills, discuss questions, areas where we may need clarity, discuss concerns, implications, and just to Kathy's point, concerns that the industry has, really voice them and make sure that, we speak to Congress and we speak to legislators and educate them on what this could and how it could affect the industry, so that we can make sure that, those issues get addressed. But again, I think from my perspective, too early to tell, but also let's just focus on reviewing, understanding it, and educating with respect to our concerns.
Let me add editorially, the fact that it's 3 pages in a 1,000-page tome both means that it could easily drop out or it could easily stay in, right? I mean, it is not the center of a very complicated negotiation, which means it may easily be, if no one cares about this enough to get rid of it, it is likely to stay in, but it only takes one senator who does care about it, you know, to actually, for it to suddenly become a stumbling block. So, I mean, this is part of the unpredictability, of course, of U.S. political system. Manuel, you have the final word.
Well, along your reasoning, I think there is a 53% chance that it will pass. And that the more you read about it, perhaps it will take more than one senator to really try to strike out. The central issue is it worth taxing the poor in this context? Because the bottom line is that it's a tax on the poor, people who earn basically very low income. Will it really benefit the U.S. revenue system along those lines? And once you reason in the Senate this aspect, perhaps it will be, again, once it goes into reconciliation, you gotta work with what you have. And as is, you know, you did drop from 80% applicability, your universe of people who will have to pay the tax goes from 80% to 27%. Still, is it worth really following this punitive approach? That's the question.
Thank you, everybody, for joining us. Those online, thank you for your patience online and being with us. For those of you in the room, it was really great to see all of you here. And I'm sure, you know, please feel free to continue speaking with the speakers here. And we look forward to seeing you at future events at the Inter-American Dialogue.